Good morning, everybody, and welcome to our next webinar for this year. This is on year-end tax planning, and we have one of our partners, Chad Reese, in our Savannah office, who's going to be presenting to you guys today. Before we get going, I just want to go over a few housekeeping items that we have. And just to start that off with, again, I'll just say welcome to you guys. Thank you for taking the time out of your day to join us. We will be doing a random prize drawing for those of you that are attending live to receive one of our branded Arctic cups. So we'll be drawing those names, and I'll reach out to you individually if I draw your name for that. If you have any questions during the presentation, feel free to utilize the Q&A text box at the bottom of your screen and send those over. After Chad is done presenting, we'll kind of go through and monitor the Q&A portion of that, and he'll try to answer as many questions as he can in the time that we have allowed for today. And then if you have any technical issues, we have myself and one of our other IT people on as well that are helping Chad manage through this. And so if you have any issues, just use the chat feature and we'll attempt to help you with those items. And then you can refresh your browser if something is not showing up correctly, just to kind of troubleshoot that as well. And then feel free to minimize Chad's video if you need to the upper corner of your screen so that you can see his entire presentation. But again, thank you for joining us today, and I will hand it over to Chad.
Well, good morning, everybody. I appreciate you being here today. I hope you're excited to talk about taxes this morning. I know I am. For this meeting, I'd like to go over tax election law changes, overall numbers for this year and next, planning strategies that we like to employ, and for the format of how we like to help clients with taxes at the end of every year. Tax changes with the election. Going over the tax changes for the election, there's a few things to remember. There's no tax simplification this year, but when changes will occur. Now, considering the law will not be changed until next year, because, nothing's going to happen in the next 11 days of this legislative session. A few things worth considering are clawbacks. Clawbacks in this instance are retroactive tax increases that apply to a period of time before the law was changed. An obvious example of this would be a tax law change that happened in the fall of 2021. If this happened in the fall of 2021, it's highly unlikely that the entire year of 2021 would be affected. If it was, that would be considered a clawback. Clawbacks are considered unseemly. Although unseemly, they're not necessarily unlawful, and they have happened on small scales in the past. However, it's likely that no tax bill will get passed that will have any effect until after the tax year of 2022. And a significant possibility as well is that if neither side can get a tax bill through, the Tax Cuts and Jobs Act of 2017 is set to expire at 2025. So we'll have similar tax law for several years to come. Tax changes under the Biden plan. And keep in mind that this is his campaign plan. This is what he advertised to get elected. So this isn't a fully passed tax bill, and it could be a little rosy, and obviously it's light on details. But just to give you an idea of what would change if he had his way according to his campaign plan. The top individual tax rate of 37%, as it is now, would go up to 39.6% for married filing joint taxpayers with income in excess of $620,000. The overall dividend and capital gains rate would go from 20% to 39.6% on income in excess of $1 million. Now, for a lot of people, capital gains rate is 15%. However, 20% capital gains rate does apply to some high income tax earners. A big one would be the Social Security tax donut hole on wages and self-employment income higher than $400,000. So the way this works, a donut hole works. Currently, Social Security and Medicare taxes are taken out for 6.2% and 1.45% respectively. For wages and self-employment taxes earned up to $137,000. Now, anything over $137,000, you still have to have the Medicare tax paid. However, the 6.2% tax is not taken out any longer. The employer has to match both parts. With a donut hole, once it gets up to $400,000, the 6.2% tax would then be taken out again. So there's a hole from $137,000 to $400,000 where no Social Security tax is taken out. And it's worth remembering that the 6.2% is matched by the employer or alternately by the self-employed taxpayer. So it's actually more than that. It's 15%. The donut hole would have a significant impact on people with self-employment income in excess of $400,000, of course. The qualified business income deduction would phase out for taxpayers with income in excess of $400,000. Currently, there's not an income limit on the qualified business income deduction. The itemized deduction, the P's limitation comes back for people with income over $400,000. Most people probably don't know what that is. It was definitely there when I started doing taxes. And it's really difficult for me as an accountant. So on an itemized deduction schedule, Schedule A, you basically have your charitable contributions, mortgage interest, and taxes. And you add the three up together and you get your itemized deduction. The P's limitation, when you have income in excess of $400,000, it starts limiting it. The higher your income goes, the more your itemized deductions are limited. There's also a clause in his tax plan that will maximize the benefit you get from itemized deductions to 28% of your income tax. So that limitation would be there as well. Corporate tax rates would go from 21% to 28%. I know a lot of C corporations have enjoyed the lower 21% tax rates, as I'm sure a lot of really big businesses outside of Savannah have as well. The estate taxes, the exemption per person is going to go from 11.58 million to 3.5 million. And that is a big drop. You know, this obviously doesn't apply to everybody, but it is worth considering that the portability of unused exemption from one spouse to another is permanent. That was passed in about 2013. Basically, that means under the current regime that if one spouse has 11.58 million and they die, they can pass along through their estate to their spouse their 11.58 million, which basically adds up to 23 million, which exempts most people from having to pay estate taxes. Even under the new regime with the Biden tax plan, it would be 7 million essentially that a married couple could hold on to and pass along without having to worry about estate taxes. The estate tax rate for the amounts over the exemption would go from 40 to 45%. It's not dramatic, but they're very high numbers to start with. The stepped up basis goes away. And basically what happens with that is when you die, when you pass something along to a decedent, they receive the fair market value as their basis. So if they were to sell it the next day, they would essentially pay nothing in the way of taxes. This was set to go away, and obviously the campaign tax plan was very light on details about that. There's a bevy of new and expanded tax credits that have been listed by the Biden campaign plan, and it's too long to mention. Some of them are pie in the sky. A lot of them are just expansions of what the credits are currently. Overall, something to remember with this is that if you'll notice a recurring theme, it's nobody under $400,000 is going to see their tax increased. I don't know if I believe that, but that's what we know as of this moment. And the caveat to all of this is that one is Joseph Biden inaugurated. 2 Georgia Senate seats would have to flip to the other side. And during a tax vote, the Democrats could have no defections in the Senate. So, you know, it's obviously not a given that any of this would happen. I'm just kind of presenting this. 2021 tax facts as we know them. The standard deductions go up marginally. As you can see, nothing much here changes. If we go to the phase outs for retirement, I mean, we're seeing small cost of living adjustments, inflation adjustments, essentially across the board. And the overall purpose of me showing you this is that not much is changing this year in individual tax law. And just to give you an idea, again, this is the graduated tax rates for 2021. These are unchanged from 2020. We frequently use these charts when making decisions to kind of fill up the bottom rates of really low, bottom rates of income, the bottom income to tax rates, and know where the delta is for higher taxes. And that way we can kind of, when we can control the income, we like to use that. What did change? The CARES Act came out in late March. A few highlights I deem relevant. I'm in increasing amounts of importance I'm showing here. Required minimum distributions. There's two benefits here. There's no requirement to take them for 2020. One, obviously, you don't have to pay income taxes on their distributions if you don't take them. And also, it potentially allows you to let the amounts in your retirement account continue to grow tax-free for purposes of passing it down to a decedent. This is a situationally useful change from a tax planning standpoint. Some people's taxable distributions occupy low income tax rates, and so, you know, why not pay the low amount of taxes on them? Some people live on it, so obviously this doesn't apply to everybody. It's late in the year, and you obviously may have already been taking them across the year. We have had people, depends on your financial advisor or your financial administration company. We have had people pay it back, and they would not be required to take that as in taxes. Now, obviously, that's dependent on the company you're working with, but it has been a useful solution for a few people. And the qualified improvement property technical correction. So in the 2017 Tax Cuts and Jobs Act, the purpose of the bill as it was written was for qualified improvement properties to be depreciable over a 15-year period. But there was an error present in the last second drafting of the text, and the IRS labeled it as a 39-year property despite congressional intent. And it was really comical seeing what Congress turned in. It was like scrap sheets of paper with just scribbles and notes. So, I mean, it was, it being that last second did leave it prone to error. However, the CARES Act in March of 2020 corrected it to where that qualified improvement property is actually depreciated over 15 years. The reason that's especially beneficial, other than the fact that it cuts well over in half the depreciable life of the period, which allows you to expense it quicker, it makes it eligible for bonus depreciation, which in all cases, or I guess you have the alternative to do it either way, but it gives you 100% depreciation in the first year on those improvements. And of course, the big change from the CARES Act is the payroll protection program. It's relevant as there are about 5 million of them out there taken out. I'm sure some of the people on the call have also taken them out. The rules have changed constantly and dramatically over the course of 2020. It's been a real hustle for us and counterproductive sometimes because it's changed so much over the year. And interpretations and readings that seem fairly obvious have been overturned at several points along the way. On the other hand, what is reasonably, or what is it? So what the change is, there's been increased scrutiny for loans over $2 million. Actually, let me go back to the last slide. There are a few other things I wanted to go over here. The basic premise of the PPP loan was to give loans to businesses to sustain payroll during the COVID-19 shutdown. If a series of criteria are met, if you spend the money the way they ask you to, these loans would be forgiven. The intent of Congress was for any loan forgiveness to not be included in income. However, the IRS has determined that the forgiveness instead has insisted that the forgiveness instead reduce deductions, which is obviously the same thing. The practical application when preparing your taxes is ironically to include the forgiveness of your loan in other income. Developments in that, recent developments, there's been increased scrutiny for loans over $2 million. Obviously, that doesn't apply to most of the loans. This is a Form 3509 with a lot of financial scrutiny. There's no way to really know how most of this is going to be interpreted. And they're not saying how to do it. For GAAP financial statement purposes, which is basically your book financial statements, this is to be treated as a liability until the loan is forgiven. However, 2 weeks ago, prior to our previous thought, the Treasury Department released an opinion that this is to increase income in 2020 if it is reasonably expected to be forgiven. I think that most people expect it to be forgiven, and it's going to affect you in 2020. We weren't seeing this, and in addition to that, this had been a means of tax planning for some people not to apply to have it forgiven yet, and that means of tax planning is now a moot point. The reduction of deductions is not currently thought to affect self-employed individuals who took out the loan for their 2019 self-employment income. As a self-employed person with no employees, you do not pay yourself from a tax perspective. You pay tax on the income. Therefore, there are no deductions to remove. This is an odd construction, but it matches the way the law was written. So this doesn't apply to you if you have a Schedule C and no other employees. You should still have it forgiven, and you don't have to pick it up as income or reduce your deductions in any way. The reasons we do tax planning, obviously, is to minimize taxes, but also penalties and interest due. We can calculate around that to make sure that you don't have to pay anything in excess of what you ordinarily would or are required to. Also to maximize cash flow. Know when and how much is due in the way of taxes. You can put some off and just pay what you have to now, or you can make decisions based on what penalties and interest you're comfortable with in order to maintain your business's cash balance. Assist with economic and planning decisions. We see a lot of things happening. Well, this is obvious too. I mean, when your taxes are due, this allows you to pay them when they're needed and hang on to it as long as possible. It also lets you know how much to set aside and gives you an idea of what you can do with your business in the interim. Consultation on business. We see a lot of things across a lot of industries. We can help. Plan strategies before the end of year. Most things that can be changed have to be done before the end of year. Therefore, that's why this period of time is critical for tax planning. Year-end tax planning strategies, safe harbors. These are a lot of things I like to use. These are, generally speaking, there's other things we do, but these come about a lot. Safe harbors, having the correct amount paid in based on the prior year prevents penalties and interest until the following April, no matter how high your current year income becomes. Conversely, if your income drops, we can estimate your income for this year so that you can pay in a lesser amount while still avoiding penalties and interest and holding on to the additional money. Safe harbor usually requires 110% of your prior year taxes to be paid in, and that's not applicable if you're having a down year in 2020, which a lot of people are. Retirement opportunities, take the maximum amount of advantaged retirement vehicles, IRAs, 401k, set payments. We can help you with these calculations. Generally speaking, point them out to you and hopefully allow you to take the most advantage of it. Large purchases, if economically needed, it may make sense to make a large purchase before the end of the year, which can take advantage of immediate expensing via 179 and bonus depreciation. 100% expensing for a lot of assets. I personally don't believe in making large purchases at year end, especially when you're taking out debt to do so, if it doesn't economically make sense to do that. However, if you were going to do it either way, timing can make a big difference. I mean, you can defer taxes by doing it before year end, making the purchase before year end. Cost segregation is a little esoteric, but for large building projects, we can pick apart the components of the installation and find the parts that can be depreciated over shorter amounts of time, making them eligible for bonus depreciation, frequently at 100%. Basis monitoring, this is probably a little esoteric too, but if you have a partnership or an S Corp, you cannot take losses and sometimes have to pick up income if you do not have enough basis at year end. Again, that doesn't apply to everybody, but a lot of you guys do have partnerships and S corporations. Changes in tax law strategies. From an individual perspective, we're largely free from this year end, but we do a lot of this whenever new tax bills come up. With the state income tax limitation in 2017, we played a lot of games with that. It's fun working with clients on new tax law changes. Obviously, deferral or acceleration of income. Most clients benefit from deferral of income in most situations, and that's usually what most people are looking to do. Despite the potential changes from the election, generally deferring income is still where we're at right now. Again, for most people. Alternately, and something to think about in a low income year, it may make sense to create income to offset itemized deductions and to kind of fill up your lower income tax brackets that I showed you earlier. Roth conversions are a good example of this. You take a regular IRA, convert it to a Roth, you pick up the income from having done so. And then the Roth is not taxed whenever you take the money out of the retirement account when you retire. And alternately, there's a lot of games that can be played with estate tax planning with Roth IRAs that you can't do with regular IRAs. So that's something to think about. Like a lot of businesses, when they have a bad year, they have a really bad year, like losses or negative income. That's always something to consider if you have the means to do so. Bonus strategies. One-time year-end payments can be used for S corporations to establish reasonable compensation, which is required by the IRS. Instead of doing the hassle of paying yourself all the way across a year, you can just do it once at year end, and we can help you calculate that. C corporations typically like to bonus owners compensation to minimize double taxation. The lower your income is in a C corporation, obviously, the less it has to be taxed again as dividends to take the money out of the company. Obviously, that has to be taken with a grain of salt, but most people do like to do that. Separately, this is a terrific vehicle for paying in taxes. To expand on this, you have to pay your taxes in evenly across a year. A lot of people have to do that with estimates. If you don't pay it evenly across a year, you're subject to additional penalties and interest. However, withholding from W-2s are treated as having been paid evenly across the year, as I said, and the withholding is only paid at the end of the year, as with the paycheck. And you can generally use any kind of withholding for the same result. For example, an IRA an IRA distribution like an RMD, or I won't go into that far. Timing of sales, of course, put off or accelerate gains from sales, or to perhaps match the two to prevent uneven results, which can also result in additional net additional taxes. Something we've been using a lot of since I think I just jumped slides here. Here we go. A strategy I've been using a lot since the 2017 Tax Cuts and Jobs Act is the bunching strategy. And the bunching strategy, just to kind of take a step back on that, itemized deductions are currently composed of deductible taxes, mortgage interest paid on your primary residence, and charitable contributions. With the Tax Cuts and Jobs Act, the tax component of that is capped at $10,000. So a lot of people have paid off a lot of their mortgage and don't have a lot of mortgage interest. And therefore, the three of those together when you add theirs up, is less than the $24,800 standard deduction. Therefore, despite the fact that they've paid all these amounts, they don't get benefit from them. Instead, they get the greater amount of the standard deduction. However, it doesn't allow them to deduct their charitable contributions. So the bunching strategy, the idea of that is to take all of your charitable contributions you're going to make over the course of 2 years and pay them all in 1 year. And the way that works is that gets you over the hump for 1 year. And the next year you don't have any charitable contributions and you're able to take full advantage of the standard deduction. Without going into calculations, this saves you taxes to the extent that you can go over the standard deduction on the bunching year. A lot of people don't like that because they like to, a lot of charities and churches and that sort of thing depend on, a more even graduated approach of giving. There is a fun way we've had getting around that is the donor advised fund. We've had great success with that. Basically, you get the contribution benefit when you give the money to the donor advised fund. And then while it sits in the fund, you get to determine who and when the amounts are distributed to. And the funds also, depending on which one you have, we've seen them grow a lot with the market. So the amount that you don't get a benefit of that, obviously, but the people you donate to do. Let's get back here to tax credits. This is a little more client specific. Generally speaking, R&D credits for some businesses, Georgia film credits, rural hospital credits. Some of this isn't as useful these days, but were very useful in 2017 and 2018. Some of them can be rather dramatic. We try and pay attention to the clients and their businesses to see where this may be applicable. Business ideas and consulting. This is kind of, we see all your numbers. We see what you have going on. Sometimes we can have ideas or help you with it. Gifting and estate. You can give $15,000 a year per person without having to file a gift tax return or affect your gift and estate tax exclusion, which we discussed earlier. To give an example of how powerful this can be, a married couple can gift $60,000 to a married child over the course of a year. The taxpayer gives $15,000 to the child and another $15,000 to the child's spouse, and the taxpayer's spouse gives $15,000 to each as well, adding up to $60,000. In addition to the $15,000 annual exclusion, any amounts paid towards tuition payments directly to an educational organization or medical expenses paid to a provider do not require a gift tax return and also do not affect your exclusion, lifetime exclusion. Not on this list, different methods of accounting. We look at that with different kinds of businesses, and that can add to some dramatic deferrals of income, again, for certain businesses. What we like to do for tax planning. So for businesses, and this looks different for every business, but if we can get a hold of your books early, we kind of close it out to the extent we can, which allows for predictive planning. We can, estimate what you're going to make for the end of the year in taxes, and then use that to do planning for you personally, to see what you're going to owe in April. Also, like when we see your books top to bottom, we can identify the issues and go over them now, or perhaps see some opportunities for you. It also makes for faster completion of books at year end. So, if we've closed your books out through November, it only takes a little bit to close it out through December. And closing out your books obviously looks different for different people. We see a lot of QuickBooks people come in. Some people already have everything reconciled and tied down, and they just need things to be reviewed, gone over. Perhaps they have questions. Some people, we do a little bit more thorough closing of the books where perhaps we reconcile things or move some expenses around, make sure that things are categorized in the correct way. Once the books are done, we can do book to tax conversions of income. Obviously, what's on your books is not going to be match exactly what shows up on your tax return. We can do the conversion for you, let you know what it's going to look like on your tax return. Income and tax predictions based on your scenarios. Perhaps you decide you want to purchase a new truck for $80,000, or for example, come up with what you want. We can look at multiple options, and you can see what that would cost you in taxes. It's good for communication. Obviously, us being together, we can give advice. We can go over tax law changes to you, and we can go over the opportunities and pitfalls of what could be available to you or could hurt you. Additionally, too, we spoke earlier about the payroll protection program loan. We've got a team set up here of multiple people across multiple offices that can do anything from advise you on the PPP loan to actually prepare your application for you. Feel free to give us a call on what that would look like, and we'll be glad to help you with that. But that is available, and I did want to bring that up while I was going over tax planning. And I'm going to open up the Q&A. I see a few questions. Okay, so Frederick is asking the question, do we get to deduct from our taxes only about 30% of what we've been given? So I think I understand the question. I'm not sure. The way it is currently and the way it will be next year is when you donate to a non-for-profit, if it's a 501(c), which is a specific group, but they're very commonplace. If you donate to a charity that has that, you get to deduct the amount given from your taxable income. And therefore, whatever your tax rate is, whatever your highest graduated tax rate is, that is essentially what you save in taxes. I think that answers your question. Feel free to follow up if it does not. Under the Biden tax plan, they're saying that the total amount of itemized deductions can't benefit you over 28%. That's currently pretty much unlimited right now, or it's very high. Okay, Jeremy Schaefer, and maybe I shouldn't say the names, you mentioned the intent of the PPP loans was that they would not be treated as income. Is that the same for individuals receiving the $1,200 stimulus payment? Is that considered income or not? So the $1,200 stimulus payment, the way that looks is that's actually a refundable 2020 tax credit. So it is a prepayment of a tax credit you will receive in 2020. Therefore, it is not taxable income. It won't cost you anything. And if you did not receive it, that means you will receive credit for an additional $1,200 on your 2020 taxes. Again, please let me know if that does not answer your question. Does anybody have anything else? This is a new format for me. I'm used to being able to read body language and have verbal feedback. Okay, this one is, if my wife and I gift $15,000 to a child, we get to deduct $30,000 from my AGI, but they must declare that as income. No, that is not the case. So the only benefit to gifting $15,000 to each child is that you can gift it to them without having to pay gift and estate taxes on that money. You do not get a deduction, and they do not get a benefit from it. They don't have to pick that up in their income. This is not an income tax idea. This is an estate and gift tax problem. And if you do gift over $15,000, you have to file a gift tax return. So that's kind of where I'm going with that one. Okay, the next question is, if you didn't originally qualify for stimulus, will you receive tax credit at the end of the year? The answer to that is no. No, you will not. So the criteria for issuing a check is actually going to be different than the criteria for receiving the credit for 2020. They were just guessing at who would be eligible for it and threw the money forward. However, if you did receive the check and you're not qualified for the credit, it doesn't affect you. It's really weird year, really weird process, and they were just trying to get as much money out as possible. Okay, and this one is, can you repeat if you didn't receive the $1,200 and it cut off after that? If you didn't receive the $1,200, basically when you file your 2020 taxes, it'll be like you had $1,200 of taxes paid in already. So you would have an extra $1,200 paid in your taxes, and it would be eligible for refund. So if you paid in enough taxes in 2020 to pay all your taxes, in addition to this $1,200, you would get a $1,200 refund. And that would be in April of 2021 for your 2020 taxes. The next question is back to the gifts. Does that benefit also qualify for giving to parents? Yes, it does. So you do not have to file a gift tax return if the individual gifts from you to each of them are less than $15,000. It also does not affect your estate tax exemption amount. If you gift a car to a child, does the value count towards $15,000 limit? Does that also apply to gifting a 529 college savings plan? So it's a pretty good question. I would think that I think the use of the car, it would take a pretty fancy car to reach the $15,000 because you're just talking about a year's worth of use. I don't know how young of a child you're talking about. And the gifting to a 529 college savings plan, I can get back to you on that, Jeff. Okay, so we were qualified for a $2,400 tax relief. Can we get a refund of $2,400? Yes, if you did not already receive the $2,400 worth of 2 stimulus tax checks.
All right, these are all really great questions. If you have any others, you can feel free to type them into the Q&A really fast. Oh, I believe there was one more, maybe, I don't know. Do you see that last one there, Chad? From Lucas.
See, I think I see it now. Can a grandparent get a tax deduction for payments into a college fund for? This one is, can a grandparent get a tax deductions for payments into a college fund, a 529 plan for a grandchild? You get a small Georgia deduction up to, I believe, $8,000 on that. It's just Georgia, so you get a 6% deduction on that. The advantage of having that for federal tax purposes is that it continues to grow tax-free, at which point when it comes out, it's not taxable. Any insight on what Biden might do with the taxability of IRA distribution assets? I don't think there will be any changes on that. I don't see any reason why that would have any changes. And to confirm, gifting doesn't necessarily help the giver's tax burden, and that is correct. In your current year, your income taxes, it doesn't affect anything. That's right. The benefit is you don't have to report it. You don't have to file a gift tax return. And in addition to that, it does not come out of your estate exclusion, which may not affect you if you're not worth, so currently it's about $23 million.
And I can answer that last one. Will we send a copy of the slides to the participants? We are planning to send out some follow-up information, including the slides, to everyone that has joined in today. So the answer to that is yes.
And I wrote earlier about if Biden was inaugurated. That's just, there's lots of conditional things that could have happened. I'm basically just throwing out everything. I wrote these slides a little while back, so I'm just throwing that out there.
Awesome. Well, thank you so much, Chad, and thank you everyone else. Like I mentioned before, we will be following up. If you have any additional questions, feel free to reach out to myself or Chad as well. We can share his contact information, and we'll be following up with the slides and possibly with the recording of this webinar. And then I will be announcing the drawing for the winner of the Arctic Cup. So hope you have a great day. Thank you guys for tuning in, and we hope that you guys stay safe.
Thank you guys. Hope you all have a Merry Christmas.